Hello, Smart Money Street podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Diana Perkins. How are you doing, Diana?
Doing great, Kirk. How are you?
Good, good. Well, glad to have you in the show. While we kind of dive in here, tell us a little bit about yourself.
Sure, sure. So, from a really early age, I knew finance was my calling. When I was 9 years old, I was charging my sister interest on small loans. It was my risk premium. And when I was 18, I negotiated my first car loan using the concept of the time value of money. So, I always knew finance was it for me. But it really wasn't until college when I was first exposed to the stock markets in a virtual stock exchange competition. I'm very competitive, that I knew this is what I wanted to do, but I wanted to do it on my own terms. And at that time, there was floor trading. I'm 5'2". I'm female. There weren't a lot of women. So I had it in my mind that I'll, get a good corporate job, get my CPA license, save up money, and someday go out on my own. And 10 years into my career, I did that. I learned how to trade stock options, derivatives, fell in love. I had the opportunity during that time to work with hundreds and hundreds of aspiring traders in a coaching and mentorship capacity. It was the best part of my day. And then fast forward, I now run my own trading education business where I help those who are completely new to the financial markets get into trading in a confident way with an eye towards risk management, of course, as well.
Nice. So you worked with a lot of traders, huh? I can imagine knowing a few of them. There's probably a lot of interesting stories. What's like the craziest story that you've heard?
Uh, well, I will say, so I worked with two different, I'll say like classes of traders. So I worked with options traders, which I always say it's akin to almost like an engineering mind. And I also worked with currency traders, which is in my mind more akin to gambling. So, and the kind of the risk takers, right? It's shorter term. I will say almost every single trader I worked with had blown out at least one account. And to me, my background is accounting, CPA. To me, that's like the worst thing that could ever happen in your life. And I used to say that, well, that's a rite of passage as a trader. And let's talk about risk management. So I'll keep it clean for purposes of the podcast, but I will say just how folks get into the markets, and it's usually you have to be, take a couple punches to the chin first before you learn how to do it the right way. So I'll leave it at that.
Yeah, it's interesting. That's something I've heard. It's the price of admission or the it's your tuition cost is when you start and you lose a good amount of money. That's the cost of tuition. Interesting though. So you work with option traders. So I love options, so I'm fascinated. So what did you learn from option traders? I mean, the engineer mind, I totally get. You have to be because it's all about numbers more than anything else. But like, what'd you learn from that? Like, what were some of your biggest lessons?
Yeah, so one thing that surprised me is the background. So they weren't all engineers, just the mind, but the background of folks who wanted to get into options trading and how many, just like me when I started, were a bit intimidated by the complexity of options. I mean, I got in from, I took that college class, I learned what a call and a put was. I said, great, someday I'm going to do this. But when you when you learn it the right way, you learn about the Black-Scholes pricing model. You learn about buying and selling, the Greeks and the pricing. And we worked on, a lot of spread strategies. Verticals were my favorite. And you learn how complex it is. And it was interesting working with so many diverse minds who came in and felt, I don't know if I can do this. And kind of helping them get past that hump. And then the other piece of it is just the discipline around it. So one of the things that I learned working with so many traders who are aspiring, to be professional traders, is that just about anyone can learn the rules, so to speak. Like I always say, you don't run into two-lane, highway blindfolded. You can learn the rules, but it's like 80 to 90% mindset. It's discipline and it's fear and greed that moves the market. And that's the part that so many traders struggle with.
Yeah, no, I Yeah, the emotional element, most people are not in control of their emotions. So I think that applies to humanity as a whole. Um, so so interesting. So which strategies you said you dealt with currencies and options and I assume some others. Like what's your favored form of trading?
Well, at that time, so I traded three accounts all very differently, but my primary account, probably 95% vertical spreads. So, bull call, bear put, credit spreads as well. I love those because you hedge out volatility, like 4 to 5 week time frame, about 2 to 1 risk reward for those who trade options. But I love that. It's almost like a set it and forget it position size to max loss. You don't have to worry about trade management and taking half your position off when it reaches its target or trailing stops, anything like that. So I love that strategy. It was my safe haven. I also love diagonals or calendar spreads because you can transform them when the short leg expires. And then one of my favorite is on the flip side is earnings plays. So I just hold those maybe 1 to 3 days. Ratio back spreads, love those because you can be completely wrong and still make money depending on your spread. And then I came up with this sort of hybrid approach where I would buy or sell out of the money vertical spreads as earnings plays. And if they didn't make the leap that I needed to in the short run, I'd hold them for 3 weeks and give them time to run their course. It was kind of like a built-in plan B for that strategy. So that's primarily what I traded in my main account when I was a trader.
Nice. Do you still trade or what do you still do those? That's still your favorite?
Oh yeah, yes. I'll trade until the day I die. I mean, I profession, I guess full time. In one account, my goal, this is going to sound completely backwards, but it was to run it to zero and I just traded on emotion because I wanted to see, what if, just, you know, three sheets to the wind, just, what would happen? And it was really hard actually for me to run it to zero. I think I have built-in controls because I'm a bit type A, probably disciplined to a fault. But it was fun and interesting. So anyway, to answer your question, yes, I still trade. I trade one account and then I have a virtual account for my stock pick service. And it's primarily options, ETFs, and stocks. And I still love it as much as I did the first day.
That's a really interesting idea. I've never heard anybody say that. Just deliberately try to run your account down to zero. I mean, obviously, I assume it's not a lot of money, but like trying to run it down, like that's actually I can imagine that'd be pretty hard. One of the things I've thought about in the past because I think we all you invest, you gamble, you take risk because you want to win, right? I mean, everyone wants to win. You want to make money, all that. But like deliberately losing, it reminds me of the movie Brewster's Millions, where he gives him like 30 million. And he's like, bring that down to zero, and I'll give you 300 million. And at the end, he's like, God, this is terrible. Like this is hard. But um, there's a concept I use when working with people of we call it contrast to clarity. So you provide the other side of what you want to give contrast for what it is you want. So I would imagine doing that would show you things internally that you might not ordinarily see. Is that kind of the thinking behind it?
Absolutely. Actually, that's a perfect analogy. And the account, I'll tell you about it was $20,000. So it wasn't a small amount. It's enough that I wanted to be able to feel the hit. I know this almost sounds masochist, but I wanted to see it from every angle. And it was my own money, right? And I knew I wouldn't get that in a demo account. Of course, best practices, you trade your demo account like you would live money, but it's still not the same. And I'll say I doubled that account before I ran it to zero. And some of the learnings, I mean, just like that movie, right? It's harder than you would think. I mean, look at, 80 to 90% of my traders, had done that accidentally, but when you do it purposefully, it's interesting. So that's one. Two, I found I could make a lot of money in a market downturn. So I call myself a bit of a perma bull. I leaned and for reasons, anyone who's been following the market since 1926. permeable. But it's hard for me sometimes to balance that with bears, just mentally. And I find other ways to diversify. But with that, I'm running it to zero. So I made some really good, you know, five figures on a 20K account within the matter of a few days or weeks. So like I said, I doubled it before I ran it to zero. What finally happened was, because actually now I do remember this. I haven't thought about this in a while, but I was working in corporate consulting. I had a 4 p.m. call. I put on a big position right before the call, and or I'm sorry, it was a 3 o'clock call. So it was an hour before market close, and the market was wild. That position was wild, and I didn't get to zero, but I got pretty close from that one trade. So it's the market giveth and the market taketh away. And honestly, I was just relieved to be off that roller coaster. I mean, looking back, obviously it would be nice to cushion my account a little bit with the 20K, but like you said, you always it's always a learning experience, and I knew it would make me a better trader and eventually, I guess, trading coach in the longer term.
So I'm curious. So were you just randomly picking trades, or were you trying to do the opposite? Because I mean, this is an important part of this because I know, personally, sometimes myself when I've run into like hurdles or speed bumps or other people, this is one of the challenges. Is like some people are naturally good traders and investors, and it's like 10%, and like 90% of the people stink at it, and it's not. It's it's not something that you naturally are good at. I mean, our wiring from the from our ancestors when we were watching for tigers jumping out of the bush is being careful and fear and greed and all that. And we have to train ourselves. Like 10% of the people are really naturally good at it, but most people stink and you have to work at it. So how does that? What's the talk me through the mindset of like the process you go through when you're trying to bring your account down to zero. Like what are you doing? Are you guessing? Are you deliberately trying to guess to make it the wrong way or what how does that work?
Yeah, actually, that's a great question. So looking back, so I'm very heavily focused on technical analysis, and that was across all three accounts. So a lot of it came down to single stock risk. So normally I would diversify across sectors and more than one position, and a lot of it was position sizing with no protective stop. So for me, that's just crazy, right? Not diversifying and not putting a protective stop on my positions. But the positions that, I mean, there were trades that I would trade in a normal account, but maybe I, put my entire account in it and put it all on black and see what happens. Or maybe, like I said, normally it's, bullish positions, but we're in a pullback. It's short term, it's 2 to 4 days maybe. But I'm gonna short the heck out of it and see what happens. So I still use technical analysis. There were still, I trade all sectors. So it was still positions that I would trade, my responsible accounts, we'll call them. But it was more just, saying, hey, like being in Vegas, hey, I really got a winner here. I'm going to go all in. It was more so that because when I think about the traders that I worked with, or the 95% who, blow out the accounts or don't make it in trading long term, I think, it's probably the mentality. Like, let's just go all in and see what happens. There's no way this can lose. I did my analysis. It'll come back. You know, so it was more kind of trying to get into that mindset and see what happens. So to me, that's being reckless.
Yeah, I would imagine the position sizing is almost cheating for somebody like you. Like that's like a beginner error. Like I'm gonna put it all on black. Like that seems too easy to bring it to zero. But like I've always thought about um because when I first started investing and trading and doing my own stuff, like I've always thought like, there's certain things I do and like, God, if I only did the opposite, it would do so much better. And I've always wondered like what it would be like to just like do a trade and do every trade the opposite and just see what happens. And I think with options, I think we'd all be surprised at the outcome. But yeah, I've always wanted to do that. Just like with certain things, like certain things I'm pretty spot on, and there's certain things that are like, my Moby Dick. Just like no matter what, I can't trade it right. I just don't touch it anymore because I'm just constantly wrong, so I just ignore it. Um, but like I almost feel like trying to do that would be very internally instructive, just to feel how that would feel. Because it's really hard to be like, I can't, like, it's like you can't get over the hump of like, I know this is going to lose money. And then you make money, like, wait a minute, what was that all about? So I don't know. Do you have your own white whale, or how does that work?
Yeah, so yeah, a couple of things are running through my mind. So one is in terms of timing the market. So and then going back to the psychology, I think those two pieces could come into play, right? Because even when a position's moving your way initially, you're like, great, probabilities are in my favor. I'm a genius. I'm in the green. And then, but what happens is sometimes people tend to kind of cut their winners a little short, like, oh, I better take, just lock in this profit and look for my next opportunity, as opposed to kind of, so to speak, trade the market in front of you and ride it up because that's going to pay for your losers, right? We're all going to have losing trades, right? So I think, that or something that moves against you and you're like, oh, it'll come back. I think that's why oftentimes the trades that we select don't make money because we cut our winners or we get out of our losers because we panic. The other thing that comes to mind is there's a school of thought that it's not even the stock selection that makes you profitable or unprofitable long term, it's your trade management. So, to your point, say you did test out your theory, okay, I'm going to take the opposite position of my basket of 10 trades. Instead of buying these five and selling these, I'm going to swap them. And so there's an argument that at the end of whatever time frame you're holding those positions, that it's how you manage the trade. Are you taking partial profit at your targets? Now your targets are down below instead of up above, right? Potentially. Are you, how, trailing stops. Are you being impulsive and getting out of trades early? Are you, over concentrating in a particular sector or doubling down. Um, so it's and there's actually this proprietary trading firm that did an experiment where they took I think it was just like a dart at a dartboard to make their stock selections to prove out that it was just your trade management, and they actually did pretty well on that account. So
Interesting. So, the one interesting thing about options is it's all based on math and probabilities. And so when you're trading options, you're talking about you know basically the position itself is irrelevant as trade management. How do you game the options market when, for all intents and purposes, it's efficient? Right? I mean, you're trying to get 2 to 1. I've heard people say their goal is 3 to 1, upside to downside. I find it's hard to find those, but how do you how do you game that? Like how do you game a system that is, I'm not saying it's efficient, but for all intents and purposes, from an engineering perspective, it's efficient.
right. Great question, especially when it's, I'm gonna call this a silly term, but like manual trading, right? This isn't arbitrage. This isn't, high frequency trading. So it's through technical analysis, which is, so swing trading is what I focus on. So I'm holding positions 3 to 8 weeks, but let's call it 1 to 3 months, right? So you're playing market swings. So long term, I'd say, fundamentals, competitive analysis, heavier on that. You need it with shorter term. I'm not saying day trading with swing trading, but there's a heavy focus on technical analysis. So the idea, it's trend trading, right? It's I mentioned before, trading the market in front of you. So it's looking at what's the broad market doing? Is it uptrend, downtrend? Is it above its moving averages? I look at the 20, 50, 200-day simple moving averages, right? Is it above those averages? If so, what sectors are outperforming, say, the S&P, Dow, NASDAQ? And then from there, okay, what stocks, what individual stock names within those sectors are outperforming the sector that we're in? So in terms of, probabilities, we're looking at, okay, what's really strong? What's not participating in the pullback? our correction right now? What's going, so it's basically, it's better than a coin flip. It's putting the probabilities in your favor and managing risk on every single position. So that's the edge, so to speak. And then the risk, you mentioned the reward risk. To be honest, you're not always going to get 2 to 1 on calendar spreads. If I get 1.3 to 1, I'm happy. I'll go as low as 1.9 to 1 if I really want it.
Oh, wow. Okay.
If I really want it, we're not managing to the exception, but I'll be transparent.
Okay. No, that's fair. That's interesting. I hadn't thought of that. Well, let me ask you this because, one thing when you're investing in stocks, you're kind of going all in. There's not a lot of risk management other than stop losses, which are hard to manage. Which is one of the reasons I use options because I'm bad at managing stop losses in my mind, right? 'Cause if it's not put into if it's put in the system, you get blown out. If it's not in the system, it's hard. So I like options for that reason. But one thing you do with spreads is you're giving up on the upside. So let's say you're doing swing trading or you're trading with a trend. The ideal is to let the winners run, but with options, you're cutting your winners short. So um, how do you manage that so that is in your favor?
Yeah, yeah, great question, especially when it's vertical spreads, which, as you know, with the pricing model, especially given theta, that last week. So I'll say I hold position, 4 weeks. That's sort of my sweet spot. That last week, you could be Wednesday of options expiration week, and you're at almost 100%, max loss. But on the flip side, you're only about, 60 to 70% if you're lucky, max gain, even if you're at your target price. And you really have to hold it on those last 2 days to get that full 2 to 1, right? And that, some might say that's a losing proposition because how often are you going to reach that target unless it's relatively conservative? Um, so with that, I'll say when I started trading, and perhaps for that reason, I was break even like a lot of traders are when they first start out. The way I started becoming more consistently profitable is I would stagger with weekly options. So I had more positions on in any given month. So there you have diversification. Assuming we're not at 0.9 to 1, so assuming we're closer to 1.5 to 2 to 1 risk reward, you're making more on your winners than your losers, right? Keep this with vertical spreads, your position sizing to max loss. So over time, when you're making more on your winners than your losers, you have built-in position sizing or risk management, and you have enough trades on where it makes a difference, where it's not just 1 or 2 and you're crossing your fingers. You can ride those waves, and over time you should come out ahead. But again, it's that discipline. It's putting the probabilities in your favor and managing risk on every single position. Secret sauce.
Nice. What's one of the things that kind of comes up with options too a lot is position sizing, as you mentioned. Um, how do you focus on position sizing with options? Because it's not like you buy a stock, you buy 5% of your account. With options, it's a little bit different because there's leverage built in inherently in there. How do you position size?
Actually, it is a bit for me. It is actually a bit similar to stocks, even given the complexity and leverage that's inherent with options. And that is on any particular account. I mean, this is going to sound like widespread, but I would say, 1 to 5%, probably like 2% is the sweet spot on any single position. So when you purchase an options contract, say you have, $100 account, you want to risk, we're gonna make it really simple. You want to risk $20, or sorry. I guess, gosh, I don't need $2.
$5.
Yeah, $5. Wow. Okay. I need to use bigger numbers next time. Right, $2 to $5 on a position, these are two small numbers, but anyway, so you're
100,000. How about that?
okay,
100,000.
yeah, 100,000, um, 5%. So yeah, so you're risking 5K. So you look at a contract, you're like, okay, it's 250. I can buy this many contracts to get myself to, 5% or 2% or whatever that is. And so it's essentially the cost of the options contract, times the number of positions that becomes your amount of risk. Obviously, the contracts, it's typically, not always, but typically, right, 100 shares that you're controlling. So yeah, so that's how I do it. And then risk graph. I love visuals. So I look at my risk graph, just my double, triple check, and I'll just make sure that, that lower line on the loss, it's below whatever that number is in terms of my risk.
So, all right. So just to be clear, let's say you have that example, 100,000, 5Ks in a position, um, and there are 100 shares. So it'd be $50 a share position. Um, so you're buying, so let's say it was a $50 a share stock and you're buying 100 shares. So that's the equivalent of 5K. So you would buy one contract or you do a spread on one contract because the movement wouldn't be 5K, right? It's not going to 10K, right? It's if you get what I'm saying. Because you're putting a lot less than 5K up. You might be putting up $500. So the most you could lose in that trade is $500, not 5K. Just for the listeners here, is that accurate?
Yeah. Well, I wouldn't think of it in terms of the number of shares. So in the stock example, yes, it's 100 shares, $50 a share, but the contract, you might be able to control that same 100 shares for a fraction of the $5,000. It might only cost you, $250 to control 100 shares. So it's that $250 times, whatever amount to get you to that 5,000. So with the same amount of capital to control, so $5,000 to control those 100 shares in stock, depending on the options price, you could control, 500 or 700 shares potentially, because the options contract isn't going to cost you $50. It might be like $5 or depending on what the spread is. So you're controlling a multiple number of shares with that options position, risking the same amount of capital that you would on the stock position.
Well, that's what I was getting at. So
Oh,
you're not, because I wanted to clarify. So you're not buying one contract, the equivalent of the $5,000. You're buying $5,000 of option premium effectively that you're putting at risk. Okay.
exactly. Yeah, you got it. Yep. Yes.
Okay. All right. Good. Okay. So that because that's the one thing about options that I think a lot of people they either get really drawn to or they get scared away from is the leveraging factor. And so when you're putting on a spread, so obviously diversification is important. You got a lot of it's in some ways it's like gambling. Professional gamblers, they got a lot of different bets on because some of them won't play out, but if they do their math right, they will win overall because of diversification. So I imagine you're doing something similar. So let me ask you this: um, how do you manage a trade? So let's say you put that trade on, you got a spread trade on $5,000 is 5% of your account. How do you manage that? Are you putting on limits? Are you letting it run to zero, or how do you decide when to get in and out of that trade?
Yes, great question. So I have a 15-page trading plan that obviously I've now memorized because I've been doing this a long time. But it depends on it depends on the option strategy. So with verticals, I hold those to expiration. So position size up front, I know I'm, built-in risk management, hold those to expiration. With something like a diagonal spread, I wait until that short leg expires, and then at that date when the short leg expires, if that chart is still looking good to me, like I would enter it today, it's following its trend, it's above its moving averages, then sometimes what I'll do is I'll hold on to the long position and then I'll put in a stop loss, right below it to manage the risk because now it's just a long call potentially. And then I'll either, keep the stop loss where it is. I might, let it ride up maybe, by when it hits, two ATRs. Um, and then, ride up if it continues to move that direction. And then if it turns around, maybe it's a small loss or just a smaller win. So those are some examples. It depends on the strategy. With the ratio back spreads, I close out right after earnings. Whatever that announcement is, it's either a yay or a nay, so yeah, so it really depends. But those verticals, I hold them to expiration because that's really the only way to get, as much as your profit. Like you said, you're capping your gain. Like you want to get that gain, what you can. So
Yeah, yeah, no, it's Now, I mean, one strategy I used to use back in 2017 was I would sell a lot of puts, just in positions I would own, and then the options premiums just kind of went, they're just really skinny, so I stopped doing that. Um, and I wonder with one thing I've noticed a few times, and I could never find anybody who could explain it. So it's possible this is just one of the anomalies of the options market. But every once in a while, you see pricing that just doesn't make sense, and it doesn't come out in the Greeks necessarily. So, like I remember one year, I think it was 2017 or 18, we sold ExxonMobil puts in December, and it was like double the premium that it normally is. It was I don't know, it's like 2 weeks until the end of the year, and we sold the premium, and like within a week, it just disappeared and went back to normal. But it didn't show up anywhere. It's not like you can screen for this. It was just like, wow, that's why is it 10% with for like 2 weeks left? It's crazy. Um, but every once in a while you see these things. So I don't know if there's a way to track those anomalies, or if you look for that, or you're just looking for, hitting singles and doubles down the middle.
Yeah, great point. And I think there's a lot of distrust in the market sometimes because of that, because the that maybe institutions or big money are manipulating or there, yeah, or maybe there are these price discrepancies that bring another element. So I don't look for those. My initial thought as you were sharing your story about ExxonMobil, I always think in terms of tickers. I'm like, oh, XOM. It's one of my first trades. Anyway, one of the things that I was thinking about is the volatile implied volatility. But you mentioned it wasn't reflected in the Greeks because that implied that IV, that is the hardest thing, as you know, to predict or measure. And I've certainly seen options prices that feel very inflated, especially going into something like an earnings announcement. There's actually a strategy I've always wanted to try that I tried it for the election, but I haven't on earnings just yet. But it's just playing implied volatility, selling it when it's high and then right before the drop, buying it back, or, vice versa. So being out enough from the event and purchasing the contract, understanding that leading up to the event, there's going to be this excitement and a puff up, for lack of a better term, of the options price, and then sell it right before the announcement hits. So anyway, so in my mind, I was thinking, oh, that's got to be volatility. But there are probably mispricing or things like that that just don't look right. But I like to steer clear. You mentioned one base, two base hits. I am a bit of a risk taker. I know it might not sound like it. I do want to swing for the fences, but I know the winning strategy, it is probably the two base hits. And that's why I follow the strategy that I do. So.
Yeah, it's interesting you say the earnings thing. I have followed somebody who's tracked this, and I don't do this, so I've forgotten the time frames, but it was something along the lines of like 3 months out to like 1 month out, or maybe it's like 2 weeks out of the event, where if you expect something to happen, let's say in the summer, let's say like the election's coming, and you'd buy, or you'd employ a strategy then, and then like a few weeks before the event, then you take it off because the implied volatility has skyrocketed since. Um, and the person I talked to said that he uses it consistently. Like it's just you have to pick the right events, but if you do it right, it's like easy money because you're not taking a chance in the event. You're just taking a chance in the fact that people are interested in it. That's all.
Yeah. Oh, absolutely. And I would say I like that he does this consistently because it makes me think of, there's all these sayings like sell in May, go away. And then, someone's new, they're like, well, I sold and I didn't make money. Well, do that 100 times or maybe I guess 50 times in a lifetime. Eventually you should come out ahead. So I like that, if it's done consistently. I mean, the other thing that you can do is the think back tool. So I used to, when I was trading those ratio back spreads, I really don't trade those anymore now. But when I did, I would use the Thinkorswim. Back then it was TD Ameritrade, now it's Schwab. anyway, the Thinkorswim platform, they have a think back tool where you can do that analysis. And I remember the first time, I think it was Lululemon. Oh yeah, because I got crushed. It was in a demo account, but it still hurt. It always does. You always want to be right, like you said. Um, but anyway, but I remember going through the think back tool and looking at the volatility crush for maybe the last 4 to 5, maybe it's 3 to 4, 3 to 4, because I wanted to still be relevant earnings announcements, and then using that to see, okay, what does the chart look like now? What's being said in the news? How far does it have to fall or grow? What is that time frame? I think you said it like probably about a month is good for earnings. I don't think you want to go more than that because you need it like close enough to the event. But that's when I learned about volatility crush because my ratio back spread could not withstand. So anyway, but I think tools like that are helpful. You could use AI. I use that but I don't trust AI. It's the for that purpose. It's the ex auditor in me. So I'll use it out of curiosity, but then I'm checking every single number before I rely on it to make a decision that involves money.
Yeah, no, that's interesting. You say AI. I was actually going to ask that. But yeah, I love the fact that you used the toss system. It's great. That's one of my favorite systems, and I can tell you, I can't tell you how many times I've gone back to look at the flash crash in in that tool where you can go back and revisit and play it out, and you just fast forward and reverse, fast forward and reverse. I loved following that because it's just so interesting to see what was happening during that time. You can follow different stocks and what was playing where. I mean, I was actually trading during that time, and I was actually it was personally I was shorting the market into that, and then it got to the point I'm like, where's the price? I just hit market sell, like get me out of the position or market buyback. I was like, get me out of the position. Like I don't know where the market is, but it was fun. But at the same time, I was looking back, I'm like, this is crazy. Like you but. So I like that think back tool. I think it's a brilliant thing, and I'm surprised other people don't have that in their systems because it is so much fun to play with and to go back and see how things, to look at the broader market too, not just what you were focused on. But let me ask you this. So, well, first of all, are there any things like that that you play around with? Because maybe it's just me, maybe I'm a geek, but any like situations you go back to over and over and just out of curiosity.
I don't, but I actually just wrote down Flash Crash because after our interview, I want to check that out out of curiosity. Because it's like what we were talking about a little bit before, the psychology of it and how it develops and how it happens. And and I know that, the number one rule in finance, diversify. But number two, people would say is, well, maybe don't trade anything you can't afford to lose. So number three, sorry, I'll get there, is don't use past performance to predict future, events, right? Because there's so many variables. But that said, psychology is psychology, the fear, the greed, what's happening in the economy at that time, what the leadership looks like, the economic variables. And then you can look at, technical analysis, that way, or what's happening in the industry. And it's just fascinating. So no, so to answer your question, I'm not doing that now, but now I want to do it more beyond just testing a, volatility play.
Well, in the interest of time, I got to wrap it up. I got 2 minutes here, but Diana, I really appreciate you coming to the show. Probably have you back because I've thoroughly enjoyed our conversation. Where can people find more about you?
Yeah, sure. So I have a website. It's trading with Diana, just as it sounds.com. So there's lots of free resources out there. You can schedule a free call with me too, if you would like, or sign up. I have a stock picks subscription service. So that's all on there. And then also on social media at Trading with Diana. I have a weekly Q&A, Mythbusters, lots of fun content out there if you're interested in learning more.
Awesome. Well, thank you for joining us, Diana. Really appreciate your wisdom, and yeah, we'll talk to you soon.
This is great. Thanks for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. I mean, like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Diane. I really appreciated her coming to the show. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hi, everybody. Happy to be here.
Glad to have you. And we also have our very own Doug Hagerin. Hey, Doug.
Hey Kirk, good morning to you. How you doing today?
Doing great. Doing great. Well, so Barb, what were some of your takeaways from the interview?
Well, I thought she was super smart and I loved her passion. I loved her apparent knowledge about trading, about options, and also about, education. I think that's all great. There's a learning curve there. I mean, there's definitely a very challenging learning curve. And I've been a fundamental analyst for many, many years when it comes to assets. So this is not my bailiwick. But that said, I think it's important to explore and learn out more about it. It might be the path for some others.
Yeah, no, good, good. Doug, what about you? What are some of your takeaways?
Well, some of my takeaways, when I think of Diana, what stood out to me is that trading isn't just about strategy, it's about emotional discipline. And we talk about this all the time. She's coached, hundreds of traders, and the consistent thread is going to be those that succeed have a plan, manage risk with divine strategies. She talks about how she uses verticals and straddles, and mostly stay calm when others panic. Sounds familiar. Well, it's kind of very similar to the stuff you hear Warren Buffett say all the time, right? Um, whether she was working on doubling an account or deliberately trying to run it to zero for psychological insight. I like how she tests herself. I don't recommend everybody trying this. The key here is that mindset is your edge, and trading is something that anyone can do. I believe that. But I also believe that the risk is there based on your preparation, and that most traders are going to fail, not because they didn't know what to do, but they didn't have a plan, they didn't stick to it. And that same thing transcends anything in life, whether it's finance, college planning, or anything else.
Yeah, no, I totally agree. So, Barb, you're a fundamental gal. What are your thoughts on technical analysis? Should people be trading or like how should people be thinking about this?
Well, boy, you really have caused me to go deep because my belief is simple, easier is better. So I have my MBA in finance. I've been investing for 40 years. So I've got my personal experience, I have my educational experience, and in my opinion, and from the research I've read, owning a diversified portfolio, that means not only large cap growth stocks, but a diversified portfolio of index funds with some fixed income in there, staying invested through thick and thin, will get you average market returns which have not been terrible. In fact, they've been pretty good on average since 1928. You've gotten stocks over 10%. You've got bonds about 5, cash about 3% annualized. I think most of us can live with that. So, for most people, I believe that's the way to go. If you want to be a stock picker, there's room for you. You need to learn to study. If you want to get into technical analysis, I believe there are some successful technical analysts, traders, etc., etc. But it requires a whole different skill set and it requires a heck of a lot of work.
Yeah, I agree. Just like everything else. So does so does fundamental analysis. That's a lot of work too. Just a different kind. Just
Well,
to be
yeah, and
clear.
since I've been studying it for so many years, I'm familiar with it. So, of course,
Right.
in the beginning it was really hard for me as well until I developed those skills.
Yeah. And I think that's the important piece of this is that it's a learned skill. It's something you have to spend the time with. Doug, what about you? What are your thoughts on trading?
One thing I really respect and I agree with, and it's not just her, but platforms like, Trade With Me Now, that also teaches, individuals to do options or trade, is that all traders have to have a plan and they have to stick to it. That alone separates the winners from the gamblers. Whether you're looking at trading straddles, verticals, anything else, the underlying strategy doesn't matter as much as the consistency with which it's executed. Um, I completely agree with this. It's something that another gentleman says, with another trading education, is that without a clear plan and the discipline to follow it, all you're doing when you trade is gambling in a nicer suit, right? That's what it comes down to. And that's half of it. So you must have the plan. That's half the equation. The other half is the emotional execution. Most people fail with investing and traders fail as well, not just because they lacked a plan, because they've abandoned it when it hurt them emotionally after a string of losses or during a volatile spike. And so ultimately, the market's not going to reward ideas. It's going to reward execution. Like Barb said, you're probably better looking at something like the buy and hold. I mean, even Warren Buffett, I say this all the time. He tells everybody just invest in the S&P 500. Why? Because he's basically telling you you're not capable of doing what he does. And that's probably true because it's going to take the execution, and that starts with the plan. That's going to bring consistency. That discipline's going to bring results, and the emotion's going to bring losses. So if you can't follow a trading plan, no strategy is going to save you, and you're probably best just either allowing someone else to do it or following simple buy and hold indexing, with basic rebalance because it's something that anybody can do, but it comes down to most people won't.
Yeah, and I want to make one comment, and thanks, Doug. Yeah, one comment was, I think when people are looking at trading, Barb's a fundamental gal. Some people are technical, do technical analysis. There are quants. There are many different types of investing. What I found the best way to invest is incorporate all of them. Fundamentals are really important, but sometimes they don't matter. And I feel like the last 15 years they haven't mattered to the market. Not that they don't matter, but the market hasn't cared. There have been some great values that the market just hasn't realized, and yet they overprice certain stocks that shouldn't be overpriced. There's a certain company out there hasn't grown its revenues in 3 years, and yet the market just keeps growing at like 20% a year. It's crazy. I won't name it, but I've talked about it in the few times in the show. But the point being is the market is not rational, and that's the whole point. So I feel like combining the two is useful, and you don't have to be a technical analysis. Like Barb could probably do fundamental analysis in her sleep. She's been doing it for so long. The technical people, they could do that in their sleep. Like I can look at a chart and I can generally see, certain aspects of this over the years that I've picked up and say, all right, there's a strong probability it's going to do X, but we don't know. Um, I think if you combine them, you could have a simple overlay of just the 200-day moving average. It's the old school, the most basic technical analysis concept around. If the price is over the 200-day moving average, then you should own it. If it's below, you shouldn't own it. That's simple. And you could use it for any stock, any index. It's tried and true, and everyone's used it for long periods of time. Now, it's obviously that's the simple version of it. It's not always that simple, but sometimes it is, right? Is the 50 day over the 200 day? Like there's simple things that you don't have to get into all this craziness out there, which there's a lot of technical craziness. You could just stick with simple, and that's it. And if you're not doing this for a living, if you have an actual job, and you do this for fun, or you do this, in your free time, a few hours a month, there's some simple things you can do as an overlay, and that's it. And I'm not saying they're right or wrong. I'm just saying that there's things that you could look at and say, all right, here's the path I'm going to walk. And here's my buy signals, here's my best sell signals, and that's it. And then I don't have to do anything. And that simple one, the 50 day and 200 day is one of them, or just the stock price over the 200 day, maybe that's your buy and sell signal. And if that's it, great. Then you have nothing to worry about. You don't have to worry. You just follow your rule and stick to it. The problem is when people don't stick to the rules. That's the biggest challenge, as Doug alluded to earlier. It's the psychology of it that gets people. It's your brain getting in the way of a good plan. That's the problem, and you really have to train yourself. So Barb, I want to kind of ask you this because we were talking about this before the show. You listened to the term of bringing your account down to zero, and you couldn't make heads or tails of it. Um, I don't know. What are your thoughts on that?
Well, from how I understood it from the interview, she wants to test her theories to see which ones work well and which ones don't work. And bringing it down to zero was one way for her to do that. But in all of my years of investing, I can't wrap my head around the idea that you want to lose, because deliberately, which is bringing down your account to zero. So, if either of you can give me some color on that concept as to the benefit of that strategy, please weigh in.
Well, I've certainly got stuff to say. I don't know if you do, Doug, but the way I would kind of I actually love the concept. I thought it's the first time I've ever heard it, and it's so contradictory to what you think. And what I've learned over the last 10 years when I've really dove deep into psychology of investing and just people is when you try to make a change. So we're all basically pattern recognition machines. We go through our life, and I would say uh, probably 90%, maybe up to 99% of our life is done on automation. Like we're not actually actively thinking. We think we are, but we're really not. We're going through the motions of things that we've done yesterday and the day before and the day before that. We get up, we put our pants on the same way, the same leg first. We go down to eat, we eat the same thing. We drive the same way to work. We talk to the same people. We have the same routines. Like your brain is on automation most of the time. We think we're thinking, but it's based on habits that we've formed over the years. And I would argue it's probably maybe like 5% of the time you're actively thinking. If that, some people just never do. They're just zombies. But if you actively think, you have to stop and you have to force your brain to stop going in a certain direction that it's generally done. It's like if you come home and every day you have a drink, you have a beer. Like if you come home and don't have a beer, it's really hard not to because you form that habit over time. And it's like, I need that beer to relax. Like your brain has formed this habit. It's like there was a book called Switch, and it talked about the elephant and the rider and the path, and you're shaping the path. Like if you have a beer every day when you get home from work, the path is shaped. Like you can't go outside the boundaries because it feels hard. And so all of us have these habits in life, and we have a habit stack that we've built. And so if your habit stack helps you, then you have good habits. If you smoke every day, it's a bad habit. If you drink every day, it's a bad habit. If you go for a run every day, it's probably a good habit, right? So if you do it, it's easier to continue to do it. If you haven't done it, it's hard to start. So if you think about what our habit is I need to make money. I need to make money. And maybe the habit you've formed is a habit that is not helpful in what you're trying to do. I'm not saying it is. I'm just saying maybe, right? Because we're all wired differently, so there's no uniform way to think. But maybe the way you're thinking is screwed up. So that's why I mentioned the movie Brewster's Millions, because he inherited all this money, and the whole concept was I want you to hate money. So I'm going to make you spend an obnoxious amount of money, and I want you to hate it. So when you get the 300 million, you actually respect it, right? And you don't want to spend it, right? You've been through that period. So when you think about uh, drawing your account down to zero, that's something you have to fight your brain against. No, I don't want to lose money. That's stupid. And you have to, your brain's fighting you. No, don't do it. Don't do it. So the concept of actually trying to deliberately draw your account to zero, because if you think about it, let's say your odds of making a good trade are 50-50. Well, that means your odds of doing a bad trade are 50-50, right? So if you really think about it, it would be really hard to bring your account down to zero unless you're just trying to do really, really stupid things. But that's not helpful. But if you tried to do it in a reasonably normal way, that would actually be very hard. So if you tried to bring your count down to zero, then you're training your brain to recognize the bad things that are going to draw your account balance down to zero. So when you do that, you realize, oh, your brain has an aha moment where it's like, oh, that's causing this. So next time you see it, when you're not trying to draw it down to zero, you recognize, I don't want to do that because I recognize that brings me down the bad path. So there's this concept we call contrast to clarity. So if you want to figure out what's going on, you put in some extreme contrast to that, which helps you recognize where you are on the spectrum. Because if you're just trying to make a small change, you can't figure it out. But if you push to the extreme, you're like, oh, I realize the boundary's way the heck over here. I didn't realize that. Now I've got all this space to move around and figure out how to move. It's, I'm trying to explain this, but I do this a lot when I'm trying to make a change in my life where I put in extreme contrast to see how it feels in an uncomfortable way. And so I realize, oh, actually, the my wiggle room is a lot bigger than I realized. So let me get some better insight. So so it's an important concept, and I'm surprised no one else has done this. Like I've never heard anyone talk about this. This is why I loved it when she said that because it's so contradictory, but it's contrast to clarity. It's a psychological concept people who study psychology probably recognize. So I don't know. What are your thoughts, Doug?
Well, what I thought was interesting and kind of expanding on that is that she was doing it as a way to see what it would teach her. And I think this is the part that's hard because the logically, and Barb, you're very logically driven in the way you think about, investing and stuff. But um, I feel that she really understood the real mastery wasn't the winning trades. It was understanding your own personal psychology, which is, again, half the battle here. And I think she wanted to feel every emotional pull. She wanted to feel what would it be like to be overconfident, to be regret, to have FOMO on purpose, to put herself in those shoes. And ironically, she ended up doubling her account before she could even blow it up. Because here's the key. Her discipline, it was just that strong, right? She couldn't break it. And so if you can stay in control when your only goal is to lose, which is an incredible feat, it means you've truly trained your trading mind. And going back to what Kirk's talking about habits. There's a saying out there that takes like 28 days to break a habit, and that is not true. It takes an average of 66 days to break a habit, which can range anywhere from 18 to 254 days. Right? So it doesn't matter. The thing about averages is they're made up of the thing about averages is they're average, right? That's what they are. And so everything that goes into breaking a habit is going to be unique to you. But that again, the only people that break habits, and we all have little habits, we all have little ticks. We have things I do that drive myself crazy, my wife crazy, my kids crazy. They do things that drive me crazy. We all have things we wish we could fix. And the only thing that fixes that is discipline. And that is really the difference between those who are successful in all walks of life. I mean, they used to talk, Jim Collins talked about in Good to Great, right? What was it that made, that each of those companies that he profiled had in common? They were disciplined. They saw vision. They kept pushing on what he called the flywheel, and they pushed that flywheel, and they didn't let anything waver them from that vision. Now, sometimes that can, there's a difference. There can be a correlation between, or a, not a correlation, but an unhealthy switch or confusion between discipline and stubbornness, right? So discipline also builds in the ability to adjust when the information is telling you that something's have changed.
Yeah. Well, I want to touch on this one thing because we had talked about the concept of technical analysis, swing trading, trend following, all these things. Um, and I think it's important to understand the different terms. But so Barb, when you're hearing all this, like what does it sound like to you? Because you're not a technical analyst, you're fundamental. Um, how does this sound to you when you're kind of
You
thinking
know,
this
it's
through?
funny because part of my work is evaluating and reviewing various trading platforms. And so, for example, when I review Tasty Trade, which is designed for pretty much options traders, I know all the terms. I understand the names of these things. What I don't know is how do you actually do them? And so it sounds to me as someone who is familiar with the language, but not familiar. It's like I can watch a triple axel on skating. I know what that is, but I can't do that, obviously. So that's how I feel about these terms. It's like, yeah, I've traded a put and a call a few times for options trading. That's it.
Okay, cool. What about you, Doug?
Uh, the thing for me is there's places you can learn this stuff, right? Again, from her, from Trade With Me Now, and some handful of others that are out there that will teach you how to do these things. Again, I would stay away from it if you can't find that you have the right mindset and that you can't find that you're able to keep a discipline edge. But I like what you said, Kurt. You could start simply. You could start simply looking at the 200 versus the 50. You can start by implementing things that'll minimize your losses, right? She talks about verticals, and she stresses that for a reason. Defined risk can be built in to allow you to trade more confidently without checking your phone every 5 minutes. You talked about being able to, a fundamental trader can go to sleep at night, right? And nothing changes. A technical trader can do the same thing. If you have risk-defined trades like verticals that she talks about, or calendars, or straddles, there can be a set it or forget it style when those rules are followed. You can actually, in a market full of landmines, you can put defined risk trades around that act like Kevlar to you. And they don't have to be dangerous, but you do need to know what you're doing. You need to have a plan. So you can put things in strategies in which you limit your upside, limit your downside. That's an issue psychologically with a lot of people because everybody just wants the upside and they don't want to think about the downside. It's, go to Vegas. Vegas has always lived off of that. The next one's going to finally do it. Old Ohio State quarterback Art Schlichter is a sad, sad story in the history of gambling addictions because he went from this superstar to someone that has, I mean, been in jail, prison many, many times for bad checks and fraud and all that stuff because the next big trade is going to finally fix everything. And that obviously doesn't happen. And this is where people get in trouble. So, if you have the discipline, but the other is the time, right? You've got to be able to take the time to learn it. You got to be able to take the time to watch it. You can't do, it's not like you can set it, forget it forever, right? But you've got to be able to manage it. And like she said, spread your risks. You can't, it's generally not going to be one trade. It's going to be multiple trades, different things. All of this stuff, it does take time. And this is why for most people, unless it's something you can do as a full-time job or carve out at least a significant disciplined portion of your week, you're going to focus on it, it's going to be very hard to do.
Well, as we kind of wrap it up here, final thoughts here, Barb.
I really liked what Doug said. I thought that was a really concise and clear guideline. I'm going to piggyback on that and say, in general, if you're not someone that wants to live and die by your investment portfolio, but you want to build wealth for the future, and that's your goal, um, stick with a diversified index portfolio. Use a robo advisor or just pick a few index funds. I have a lot of articles about how to do this on my website, Barbara Friedberg Personal Finance. And there are also many, many, many other good resources. But let's say I have a little interest, but I don't want to blow my whole wad. I recommend this to anyone who wants to play around and maybe learn something, invest in Bitcoin, do something more speculative. Carve out 5% of your investable assets. Use that as your speculative money. That way, worst case scenario, you lose it all. You won't have ruined your future and you will have a chance to learn. And if you find out, wow, I am super successful at this, well, then maybe you do want to devote more of your resources to whatever speculative activity you're engaged in. So I'm Barbara Friedberg. You can find me on YouTube and at Barbara Friedberg Personal Finance.
Awesome. Thanks for coming on, Barb. And Doug, final thoughts from you.
Thanks, Kirk. Well, since we're talking about emotion, we're talking about money. It's a perfect segue to what I do. And I help families create custom college funding plans. So you stop overpaying for degrees by tens or even hundreds of thousands of dollars. And just like in options trading, those who have a plan reduce emotion and manage risk. The families I work with, they don't just pay less, they pay smart. And the truth, most families who are paying for college, who are trying to retire, they don't have a strategy at all for any of this. So if you want to shift from guessing to what you'll pay or what you're going to need to knowing how to pay, visit our website. It's mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com. Because in this game of paying, putting your kids through school, getting a return on that investment, not overpaying, still keeping money for your own retirement, your future, so you don't have to sacrifice your lifestyle, just like options, not planning is the most expensive trade of all.
Yeah, I couldn't agree more, Doug. And so we're going to wrap it up here. Great interview. Appreciate her coming on the show. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.